Good afternoon, good evening, and good morning here. I thank everyone for attending. I'm always honored that people take the time off from whatever they're doing, even if it's only television, to spend some time with us here at Worldwide Markets. Today, we're doing something I've only done once before, and that is I'm going to do a trade preparation, what I call a trade preparation webinar. My take on this is going to be a little different. I'm trying to duplicate as much as possible. Good evening and good morning to everyone. Be interesting to know how much distribution we have on our audience here. The only thing I can actually do is look at some of the names and try and judge where they're from. Some of the people I know and some of the people I don't know. But anyway, thank you all here. I'm assuming you're not related to Matt Ridley, the author, the American author. Nepal, are you from Kathmandu? I have been to Nepal. I had a very wonderful time there when I was there. It was a couple of years ago. So let us take a look, actually. I've never done this before. I don't know why. Let me tell you what we have. We have Russia, the UK. I know we have some people from the United States. Nepal, I assume Kathmandu. Yes, Kathmandu. Fascinating country. Malaysia, fascinating country. Also, I've been there. Italy, where I am going this summer. I've not been to Russia. Africa, well, I'm flattered. I can't tell you. I love to travel. One of the great things about foreign exchange is that I have gotten to travel and live on many places overseas. It's fascinating. One of my little girls, I have two 5-year-old girls this morning, before they went to school, we were looking, they asked me whether they were asking to have a map. And they were asking, we just gave them an atlas. And they were asking where I had lived. And so I showed them where I had lived in Singapore, a street called Yuk Tong Avenue. And of course, with the modern technology on Google, I could type Yuk Tong Avenue into the search bar and come up with a picture of my house from 15 years ago. Astonishing. Anyway, okay, let us start here. I could go on forever about this stuff. You know me, I like this stuff. This chart I took a picture of last night. Now, it was a great trade setup last night, but I had a feeling that it might not hold because I did this yesterday afternoon. This is going back a little bit more than a month. It's an hourly chart. This is a Bloomberg chart. And I took a look at this, and I knew that this was a great trade setup. I was afraid that it might not hold because Australia was coming in. And this was too good to be true. And lo and behold, let me show you what happened today. Now, I can tell you, I know it's going to sound like after the fact. My trade choice here would have been this. I'm going to go through all the reasons and explain how I came to the logic and show you some of the setups. And I'm going to tell you how I approach trading, which is a little different than most people, I think. Traders tend not to be very communicative. The ones that are, people actually listen to. So this is last night. My trade choice here would have been very simple. Back into the main channel. Go short someplace around here as soon as it crosses, or even if you're feeling a bit adventurous, to go short any place up here and wait for the penetration back into the main channel. The reasons for that I'm going to go through. That would have been my trade choice. I know it sounds like I'm talking after the fact, but it really is true. And this is what happened today. My. Don't I just look very smart? The reasons for this were quite simple, actually, which I'm going to go through. But this was, as I said, I thought this was such a good trade setup yesterday that I couldn't forego it because we're dealing with Aussie. And you won't find it like this. Channels are one of my favorite, if not my favorite, formation. There's a bar chart formation, but you can certainly use them on candles. This is a candle chart here. I'm not going to be talking in candle terminology today. That's a webinar I think maybe I'll give in the future. But you can see what happened here. As soon as you got a decent penetration into the channel, it took off. And now we're a figure lower. So that would have been a very good trade. But okay, let us start with the way I view trading. What I used to say was, well, actually I just made this up this morning, but it sounds good. That I look for technicals inside of fundamentals. As everyone who I've been talking to over the years, both here and prior at FX Solutions knows, I'm primarily a fundamental analyst. I mean, I was a currency trader for Credit Suisse, the big Swiss bank, the big universal Swiss bank. Yes, I suppose that could. Please, as everyone knows, ask as many questions as you like. I'll stop and answer them. I'll try to get to all of them as I go through. But I prefer this to be a word which is not used much anymore, interactive. I prefer it to be a colloquium rather than a lecture. So please ask any questions you'd like on almost any topic you'd like. Do not ask me about fashion because I'm not very good on fashion. Ask anyone who has seen me. Do not ask anyone from FX Street, please. They are Spanish. They live in Barcelona. They are inherently fashionable. I look at trading primarily from the trader's point of view because that's what I was. For 15 years, I sat on the trading desk, trading just about every currency at one time or other that Credit Suisse made markets in. So my view is a trader's view. What will motivate the market to move? I'm not really interested specifically in technicals, except as technical, but that's the statement. I'm very interested in technicals, but my view on technicals is as predictors of traders' behavior. If everyone has, think of it this way, and I know I went through this last time, but I'm not sure who's here and who's not, so I want to go through it again. And it's basic. That's probably a good suggestion. I'll take that. I have a tendency to run out, and one might say less charitably run on. So I'm going to go through my presentation, and then I'll answer some of the questions, unless they're specifically pertinent. Technical analysis. That is the approach that we all take to trading. That's our entry. That's our analysis. That's our explanation. But it is also an absolute entry into the mind of every other trader that's trading foreign exchange. The reason is simple. When you come in the morning, what you do is this, as a trader. You sit down and you look at your chart. You look for setups. You have running charts that go through the day, and you look for the ones that have the greatest potential. How do we decide? Part of it are the formations, like this yesterday afternoon. But what does this formation tell us? That foreign exchange, that the Aussie dollar is going to do something? Perhaps. What it's really telling us is the analysis that all of the other traders are going to make. Remember, if nobody trades, the market doesn't move. I know this seems simplistic, but in fact, it is the key to what makes things happen in foreign exchange. Now, there is a reason why we ended up much lower today, in addition to the channel you're looking at, and I'll tell you about that. But the entry into why this was going to happen is because everybody woke up, or was awake all night, looked at the chart, and came to a very similar conclusion. All of the traders, you as an analyst, are entering into the mind of everybody else in the market when you look at a chart. Now, sometimes you're going to be different. Your analysis will be different. You may have thought and come up with logic, well, we're above the channel. We've broken above the channel. The Aussie looks strong. China's recovering. It's going to go higher. Now, I would have disagreed with that, but that's a possible analysis. I think the odds were wrong on that. However, I'll tell you why in a minute. So remember, when we sit down to do technical analysis in the morning, what we're doing is looking at possibilities. What we're trying to do is increase the possibilities of our being right. What our being right means in line with everybody else in the market. So when I look at this chart, let's take a look here. Let me just close these down for a second. I'll look at the questions in a little bit. Okay, let's take a look. So this is what happened today. So think of technical analysis as little clubs. Everybody joins a couple of clubs. A couple of clubs have very large membership. Say the Channel Club has a very large membership. Moving average, large membership. And then all of the other indicators that are the zillions of them out there, RSI, stochastics, you can go on and on and on. Every one of them has a few fans, a few members of the club, a smaller club. The more things, the more formations and indicators that, and this is apart from fundamental stuff, that predict a particular event, the more people are going to participate in the move. This is an absolutely classic example of this. Let's take a look. Let's just go to one, an easy one. Let's go find, this is the Bloomberg system. Well, first of all, let's take a moving average. Okay? Simple moving average. Remember, this is an hourly. Okay? 14 days. We'll see what comes up. Now, this is what I'm trying to do. I have not done this deliberately. I just chose the chart pattern last night, but I deliberately wanted to take a look at this without analysis. There we go, moving average. We've got a very sharp rise all this time through, and up here we get a fall. Okay, you might use that to predict. Moving averages are more useful when they interact with other things. Let's take something which is a typical study. Let's go find RSI, Relative Strength Index. I'm trying to remember where that one is. Nope, I think it was right here. Hold on. Sorry. RSI, let's just use, let's use relative momentum. I mean, it's essentially the same. It's very similar. Okay? On the close. Now, what are we likely to find here? RSI right there yesterday. Of course, it's overbought. The thing about indicators is that they all operate on one principle. Probably not all of them, but most of them operate on one principle. That's simply reversion to the mean. If you're too far one side or the other, it will always predict a return to the mean or the median. So without having to look much further, I already have, if I was looking yesterday, I have 3 clubs here. The big club, the channel. We're above the channel, but you did not get a very serious penetration. Okay? Now this was yesterday, actually. Came down below the channel yesterday, but did not go back up. And then this is, I'll talk about that in a second. You also have the relative momentum index, and almost any index you pull up, whatever your favorite is, will show a similar type of thing. You get a rise like this over time from 93, and it goes way back, but I'm only doing a month, from 93 up to 97, you're going to get an overbought reading on most indicators. So you have a number of indicators that are working together. Okay, so that's my concept of technicals. The more things, readings, indicators, formations that you get involved saying a particular thing, the more likely you are for the event to happen. Again, Bollinger Bands, yes, all of these things. Because each indicator, each formation will involve and I'm simplifying this, but a different group of people as if they were all separate clubs, or give people a greater reason to do something. Remember, technicals are a way into the thinking of everybody in the market, because at base, markets are not interested in economics. They're not interested in anything except direction. All traders want to know is not whether the Aussie should be here because China is getting stronger, perhaps, and the Aussies are a commodity-driven economy, but how can I make money? How can I align myself with the rest of the market. That's your only purpose. And I repeat this, although it sounds very, very simple, because one of the greatest, I won't say the greatest, but one of the rhetorical devices that people who write about the markets, including myself, use is to personify the markets, to speak of the market this and the market that. As if the market is out there, the metaphor I use, there's a market sitting underneath Wall Street someplace, making its own decisions, and everybody up above is running around tittering and twittering and trying to figure out what the market is going to do. It's the old pogo line. We have met the market, and he is us. Actually, the pogo line, that's an American comic strip. We have met the enemy, and he is us. That probably goes back to the 60s, but I'm not sure. We have met the market, and he is us. She is us. Excuse me. They are us. It is important to keep that in mind, because you, as an actor and player in the market, as a trader who is chasing exactly the same rationale as everyone else, can enter into the mind of that beast under Wall Street, the market. And once you do, then you can align yourself with what it's going to do. Technical analysis is the best and really the only entry for this. Okay, now, let's get to a different chart. So that's the one that I had today, okay? I'm telling you, Bloomberg he's the mayor. I live in New York, and he's the mayor. He's been mayor for 3 terms, and he is not running again. I think he's 70 or 71. And we are going to miss him, because the man, even though he's annoying sometimes, in my own personal opinion, he is very competent. The city is well run when he's in it. Okay, sorry about that little digression. Okay. So let me get rid of these. We'll leave the studies up there. Okay, so what do we have here? This is a daily chart in the euro going back a year. In the euro, in the Aussie. My view, as I said earlier, on technicals is technicals inside fundamentals. Fundamentals, you could say, give you the bias, but it is absolutely necessary to understand the trend, especially if you're looking to make more than simply intraday trading profits. Now, nothing wrong with intraday trading profits, but in a situation, say, like this, let's take it here. So now that we've broken back down here, you could put another line in here that would run somewhere up here. Now, if you were overly focused on the technicals, you would be tempted, I think, to take profits too soon, which is something that all of us have a tendency to do, and all of us have a tendency to fight. The old line, cut your losses and let your profits run. Many of us have had brushes, long or short, with the opposite cliche. Cut your profits and let your losses run. So in a situation like this, you should not be too eager to take profits. The help that fundamentals can give you. Many times when you look at a setup, the odds are one way or another. They're close to even. You have to make a decision. The fundamental bias, the view, as it used to be called, when I first got on the trading desk, in 1989, I didn't know anything about foreign exchange. I didn't know anything about markets. I was an English major, a fiction major, even worse. Going down to Wall Street, I was terrified half the time. The rest of the time, I was just scared. And traders of those days were, and probably now, were not the most communicative of people. It was very much an instinctual business, especially the kind of business that Credit Suisse ran. We were flow traders. Our business was to make markets. As I would ask one of the traders, well, how do you know what to do? And they say, well, I always have a view. I had no idea what they were talking about. What they're really talking about is the fundamental aspect of analysis. They didn't do much economics, but they could all look at charts. The fundamental view is here. and it's still with us. It's important to know the factors in comprising the fundamental view. For the Aussie dollar, what are they? Fundamentals set the stage. Technicals are the action. Fundamentals don't tell you anything about when to get into a trade, when to get out of a trade, whether or not to do a trade. They don't tell any of that. We all rely on technicals or perhaps instinct, but technicals for that information, for that analysis. That's where we enter into the market. It'd be very difficult to take a look at this view right here and say, well, the Australian dollar is going up, but maybe the Australian economy is not doing that well, or China not doing that well. That doesn't make any sense. So the fundamental view doesn't really tell you very much about how to get in and out and what to do. Technicals does. Hence the important stress through all foreign exchange education of technicals. Well, that's true. But the fundamental view gives you a much added perspective on it. So that's why I always stress one inside the other. Okay. Just give me one sec. So, the fundamental view we know, and it's, as I said, it's important to understand the factors involved in fundamental views, because the biggest moves you get, this move right here, where did I put that chart? Here it is. No, it's this one. Sorry. Oh, I got to go back to the. Okay, so that's the daily. So all right, let me finish this here. The fundamental view on the Australian dollar is based on one related economic scenario. Now, it's important to know what the general factors are involved in any fundamental view, because it is always possible that one of those fundamental factors change, or at least the market starts to doubt it. And when something like that happens, all bets are off relating to the particular view. For instance, this view, Australian dollar, higher, is primarily based on one thing. I have a lot of charts from China, but I'm not sure I'm going to use most of them. Let's just take a look at one or two here. It's because Australian dollar is, as we all know, a commodity currency. What does that mean? Well, it means it supplies iron ore and all sorts of other products, primarily as far as the marginal effect on its economy goes, to the Chinese economy. An economy and a country, at least as far as population goes, infinitely larger than China. Not quite infinitely, but much larger. Okay, so this is Chinese GDP. Here we go. This is when the Chinese gave this huge stimulus right here. So what we're seeing here, come on. There we go, sorry. The rise in the Aussie dollar is this rise right here. Now, this is a quarterly. I don't have a monthly. It's based largely on that. China. Why? Because China is the biggest receiver of raw materials from Australia. It is the marginal value, if you will, for the Australian economy. Here's another inclination. Also here, same time. This is September. October is out, I think, in about 2 weeks. These are the PMI numbers. Now, a lot of the statistics out of China are, shall we say, questionable. Nevertheless, you've got to go with something. Here we go. Same thing. There is, now this goes back, I don't have a chart on this. This is about, looks like it's about June. Okay, so what do we have here? A little bit later, maybe it's July. For the purpose of this chart, it would be better if it was July. You would get the rise in the Australian dollar, no surprise to anybody, coincided with the recovery of the Chinese economy, or at least better statistics out of the Chinese economy. Okay, so the fundamental fact of this chart, of the fundamental idea that you have to remember here, thank you, I will keep that in mind, is that the basic scenario of this rise is the rise and the improvement in China. Why is that important? Say something happened in China. You could posit a natural disaster, but that's probably not as effective because the initial response on, say, a huge earthquake or something like that would probably be fearful. But the overall and long-term response would be that the Chinese have plenty of money to repair this, and it would end up boosting the economy. But say you had some sort of political upheaval in China. That would most assuredly call into question the ability of the Chinese government to continue this growth pattern successfully. There's plenty of problems in China, far more dissension than people realize. It's really not reported. The Chinese are not very eager to have it reported. So that is the kind of event or news item or development that could call into question the fundamental bias that's supporting the Aussie dollar right now, which is improvements in the Chinese economy. Okay. I've never heard of that particular formation. Okay. So that's why the fundamental aspect to what we're doing is very important. Okay, so now what I'm going to do now is we had this set up yesterday. I'm going to go back to the hourlies here. And I'm going to actually talk about specific trade setup and how we would do. I will get to all of the questions, which is a piece of good advice, after I make my presentation. And I think that is something I will do in the future, and that's a good idea because, as we all know, I have a tendency to love sidetracks. Okay, so let us get rid of the studies. This is the hourly. Now, when I spoke earlier about different indicators and different formations, each forming a little club with its fans, and the more of them participate, the more of them point in a single direction, the better chance you have of initiating and sustaining a move because more people are going to join it. That's true of time zones, time frames as well. In most cases, I would start with hourlies. Most trading takes place intraday. Certainly most trading on the interbank markets takes place intraday. Traders put positions on, they close, and that's why you often see flurries before the London close, which is something that you can probably trade if you're careful. Friday afternoon, you sometimes see some flurries in New York, although not so much. And you also see flurries on the open in London very often. Why? Because traders are coming in and looking at charts and taking positions. So most trading is done intraday, which is why I would always start with an hourly. There weren't that many times. I mean, when I was trading, we were all allowed within our limits to keep overnight positions and send orders around the world. We were not allowed, and it was a firing offense, to have a position without a stop and a profit attached to it sent around the world. That should be true of everyone. Anyone who trades without stops, it's not really trading. They are gambling. Everyone who trades without profits is foolish, in my opinion, because your job is to take what the market gives you. If you're wrong, you're wrong. Get out. So, hourlies is where I would start. So we take this hourly. We walk in the morning. Now remember, this is yesterday. And we have to do yesterday because now we don't have such a glorious setup as we had yesterday. So what do we look for? As I said, one of my favorite patterns was always channels. So we set up a channel. We have a very nice one here. Now, the decision you have to make here on this setup is, should I run the channel up to here? Come on, computer. Oh, sorry. Okay, should I run the channel up to here? Remember, we're here yesterday. Yesterday's right there. That's the end. Or should I run it here? My choice, as it was yesterday, because I showed you the chart. This is yesterday's chart. Where's my yesterday's chart? It's right there. Okay, this is yesterday's chart. Remember, this is the chart I drew yesterday. So I drew the channel right there yesterday, where I just did today. Logic thus. Channels very often. One, this is a channel going back more than a month. Two, it's based on a good fundamental view, improving China for the Aussie economy. Channels often have a brief penetration. When you have a channel that matches up, now you could also have drawn another channel line right here, and let me show you. Let's do it this way. Okay, you could have drawn this channel here, right? It's not quite as well defined, but it is very close to parallel. Parallel is probably right about there. So when you do that, let's do it this way. You could even do this. You can see why I like this system so much. Okay? Draw this channel here. Okay, look at that. So what do you have here? Another channel going back to the first here that was penetrated, but the penetration stayed with it. And where did it go? It went back down to the bottom of the channel. That tells you two things. Primarily, it tells you that the Aussies bid, which we all knew. An S, it's your chart. Okay, sorry about that. I'm not sure what that means. So, but channel penetration is not an unusual event. Right here, you might have been tempted to consider that the channel might be re-entered. Now, since it was the first penetration, you have to work, whatever your feelings are on that particular, and that will go with the trader and what they consider the view. But first penetration like that, and a relatively weak penetration that did not generate a huge run through, just a little bit of a penetration, then it stalled, is a candidate to go back the other way. This did not. So if you had went here and went short, you would have been foolish not to have put a stop here. Same thing here, only we got a different result. As I said earlier, the upward penetration of a channel is not unusual. And most of the time, the currency re-enters the channel. Because think fundamentally. If this re-enters the channel, it doesn't break by any means the long-term trend. You go all the way down to here and stay within this long-term trend. So it doesn't abrogate the fundamentals at all. That's point number one. Two, remember our motivation. Our motivation is profits. The line of the rising Aussie tells you that people are long. No position is worth its P&L until it's actually closed. The motivation for traders, given all other things equal, up here, is likely to be on the side of taking profits up there. You have buried profits, meaning not profits. You have, what shall we call, pending profits. Nobody gets profitable. Nobody's profitable until they cut the position and make the profits. Two, it doesn't break the upward trend, which I think everybody believes in and participates in. And three, you have a setup that everyone can look at and say, this is probably a good time to take profits. So that would have been my position here. Now, as I said, now I have some questions, polls I think that we do with the webinar, and I'm going to try this with FX Stream. We've never done this before. Now, assuming that this was the setup yesterday, and the choice, as I said, my choice for the reasons I just gave you, would have been to go short someplace up here. Given that, and that's around 97.20 or so. So, my first question, actually, I answered it already, but let's put up the first poll question, and then we can vote on it. cool, this actually works. Now, I've already given you my logic. So this one I've already sort of given you the answer to, if you will. But everybody can vote. I'm going to vote 2. And submit to which would be the best choice. Now, the choices, as I formulated them, are not exactly as I just said, so perhaps it's a little different. But the basic choice, we'll see in a second. As soon as everyone votes, I will. Okay, whenever it's done, just pop it up there. Okay, I'm assuming everybody can vote, so I'll continue to talk. So, the basic choice in this scenario for my analysis would have been to go short. Either if you're feeling risk eager, to go short up here. Okay? Or if you're feeling a little less or a little more risk averse, to go short on the re-entry of the channel. Either way. That would have been my choice. Let's see what everyone says in a minute. So once you take that Okay, so once you take that initial position, you have a choice about where to go. If you're really feeling strongly about it, you can go short. This was about 97.20. You can go short up there. Would have been a good trade at the moment. However, or you could have gone short once you re-enter the channel. Okay, so you could also have done something else. This would have been somebody who's really risky. You could go short. You could go long above the channel, thinking that you're going to get a break. No answer. Okay, we'll leave it at that. Buy above the main channel, only 7%. Sell below the main channel, 33. And buy above the main channel and then reverse. My choice would have been the second. Because of the reasons I told you earlier, I didn't think that we were set for any kind of break here. Okay, so let's look what happened and what one of our actions would have been. So now, the market did not really go any higher than that initial break. Okay, it came back down, entered into the channel, safety trade if you will, and didn't move. Now, why didn't it move? Because and this is why you pay attention to fundamentals, because Australian CPI was coming out, and the market knew that. Or should have. What happened? Well, Australian CPI was stronger than expected. Take a look at and what does that mean? That's a very easy interpretation. We get stronger. Okay, we get stronger inflation, especially in a relatively buoyant economy like Australia. We have the RBA perhaps more likely or more eager to raise rates. So let's take a look at the RBA. Where's the cash rate? I've got the cash rate here. Here's the cash rate. Okay, this is what they've been doing recently. Reducing rates. And they're reducing rates along with the Chinese, as far as the Chinese economy goes. But a stronger than expected. Let's get these charts back up, sorry. That one up, and this one. So, a stronger than expected, come on, computer. There we go. Result from inflation in Australia. Let me just take a look at okay, will give you a greater chance, and that's exactly what this line was here. Now, this is where it gets tricky. If you had gone short someplace in here, that unexpected result would probably have taken you out. Now, what happened here was actually also quite interesting, but it shows the strength of the event once it gets started. The Chinese did okay, well let's pull on this one. I'm going to skip the second question because we really have covered it right here. And so we'll do the third question in a minute. I'll let you know, okay? So, was this really a break? I would say no. But it certainly got a response from the market. And it's certainly, if you had gone short here on the reentry, it would have taken you out of your position. Because I think this high was about 58, if I'm not mistaken. So if you went short down here around 97, the figure, 97.10, and you're not out of your position by 58, then you're in trouble. So the question would be, do you re-enter the position? But I don't think, for my mind, that negates the initial setup. The initial setup that was true here is still true here. It's even more true here than it was here, because here you only had one break. Here you had a second break and it failed. So if I were doing this trade, I would have gone short here or here. I would have stopped myself out here, and then I would have re-entered, of course, woulda, shoulda, coulda. I would have re-entered the trade here. The original logic still stands. There is an additional factor which I'll tell you again. Plus, you knew that you have this failed break. There's nothing to undermine one side or the other as much as a failure, and that's what you have here. You have a failure based on unexpected results from CPI. What happened here is the Chinese announced that they were going to do 7-day repos instead of 14-day repos. What does that mean? Good question. And it seems to me that the market reaction was probably overdone, but it meant that the Chinese, I think, are concerned about liquidity. They're concerned about the U.S. and its eternal quantitative easing policy, and that the U.S. is clearly going to be continuing quantitative easing, in my mind, well into the first quarter and probably beyond that. Okay, more liquidity pumping out into the world's markets. The Chinese are wary of this. That was the interpretation the market put on it. But you see the interesting acceleration we have here once we got back into the channel. That particular comment or announcement from the PBOC, it's not some earth-shaking event, but it was enough to stop the rise, which personally I think would have stopped anyway, as it did before the announcement, because after all, 1 month's CPI report doesn't really mean anything. And it certainly doesn't mean that the RBA is about to start raising rates again. It's a good pop, but that's all it was. It doesn't change the basic scenario of relatively low inflation and the RBA on hold. The news from China was enough to get us back in the channel, and then we had this entry into the channel. The technical view remained true. Almost no technical setup ever works as you exactly expect. But what you have to keep reminding yourself, does the initial logic remain true? In this case, my argument would be very much that the initial logic did remain true. In fact, it was enhanced by what happened. We had a positive Aussie statistic, but it couldn't carry through. It had very limited play. And then we had a mildly negative, basically it's not actually all that negative for the Aussie in direct relation. What it is, it tells you that the Chinese are wary, that they are concerned about the effect that additional liquidity coming out of the United States may have on their markets, on property bubbles, on things like that. And so they're restricting liquidity. That's what it tells you. It tells you that the Chinese government is wary of, let me put it a different way, is trying to formulate and foster a more balanced view of a more balanced Chinese economy. That's what it's telling you. I mean, the new government that's in China has been saying this, and so now they are being very careful about what they're doing. So that's what it's telling you. It's saying that the Chinese are willing to sacrifice some growth, perhaps, to make sure that things don't get out of control and attempt to rebalance. That's what that tells you. It tells you something about the outlook of the Chinese government in Beijing. Well, slightly less Chinese growth, slightly less strong Australian dollar. That's the logic that follows through. But it's weak. It's not a change of view. It's not a raise in Chinese rates. It's not a liberation, free trading for the Chinese yuan. It's none of those things. It's a small thing. But remember, we are all looking for reasons to do something. And that particular reason coming out of China, that particular item coming out of China, is enough to bring into play the profit motive of this chart. It was simply a catalyst, as most statistics are. The effect of most statistics on the market is to act as a catalyst to an existing predisposition in the market book, in the trader setup. And that's exactly what we saw here. This market was predisposed to take some profits. After this kind of run-up, what kind of news could possibly have come out to give the Australian dollar a strong break on the upside? I can't think of any. Okay, so now let us take another look at this trade setup. And the last question, which I'll ask Aninda to put up, I would have gone, we reenacted the scenario. You go short somewhere around here. You got a little bit of a rise here. So the initial, put up the third question, not the second. Sorry, the second one we can skip. So I'm just going to end it. The third one says, where would you place a profit order for sell it? Thank you. Now, remember, this scenario that I put up yesterday was based on this chart here. Yesterday we didn't have all those moves. So the move down into the channel yesterday would have been around maybe 90. So anyway, a short order here, had to readjust a little bit for today, would probably have been around 97.10, 97 something, or 97 the figure if you prefer. So considering that that's the likely setup, that's what we're betting on. Everybody else, where would you put a profit on this one? And I haven't mentioned any orders here. The choices are 96.45, which is right around here. Now, I hadn't drawn this line here yesterday. If I had drawn it yesterday, I would have put in the first one, 96.60, but I didn't. 96.53, which is more or less on that line here, or 96 the figure, okay? We'll see what everyone votes for. And then I'll tell you some more of my logic about trading these things, and then I'll answer some questions. I'll wait a minute. Now, we can see exactly what the market did here. As on the way up, once we got above this particular interchannel marker, if you will, this interchannel trend line, the market bounced off it several times. It did exactly the same thing here. What's this item right here? It's people taking profits on this fall right here. I mean, because you've got 50 points, 40 points down here. People took profits. The profit taking stopped, and it continued down. So the question has to be, my brother just became a teacher. I'm going to have to ask him about this. How do you get people to answer? I don't actually know. I'll see what he has to say. He's teaching grade school. Actually, he's teaching middle school, which is here. That's like 13. It's like 8 to 13 here, I think. Anyway, okay. So now part of your profit-taking decision, of course, is based on how much on your risk parameters. But you should never make a profit decision simply based on how much money you want to make. Bad idea. Base your profit assumptions on what you see from the charts. One logical place to place it is obviously right here. Another item. Whenever you're placing it, never place your profit or stop, in my opinion, on a round number. Never place it on 96 or 97 or 50. Place it a little bit to one side or the other. Too many people have a tendency to go for round numbers. And after all, your point is to get executed. So if you want your profit to be at 60, remember on any system that means it's got to go 60 offered. Don't place it at 60. Place it at 65 or 63. So the first logical place to place it is right here. Okay, because of this trend line here. And you can see that that is the action that happened. I drew this trend line based on this point and this point, not based on this point right here, but it coincided perfectly. There's no mystery to any of this. People that went short here, remember, everybody's looking to do the same thing we are, make profits, needed a place to take profits. They're not running the position. They don't think the trend is broken, and they certainly probably don't want to, they don't want to wait till it goes all the way down here. They're looking for 50 points, so they made 40 points right here. Okay? That stopped, and you get a weaker view down. The other choices were 53, which is the one I said here. My first two choices on those were 45 and 53. The point I was trying to make there is don't place your point on, as I said, don't place it on the 50 level. This is particularly true of dollar yen. Japanese corporates, I don't know if they still do this, but when I was trading, Japanese corporates always had their orders at the figure. They had them at 50 every single time. And you can't outweigh the Japanese corporates in dollar yen. A lot more weight than you do. So you try to push it to your direction. Taking profits, go ahead. Stops go a little bit beneath. If you're running a stop on this one, don't put your profit at 50. Put it at 47. Put it at 46. Those 3 points may at some point save you. This is just a general rule that I used to follow. Okay, now the next logical stop right here is clear. We're not there yet. And it's very questionable as to whether we're going to get there. I don't really know. But it's right here. It's at 96, the figure. Because right here, when we got the break, it just went through, and it's not been back since. Now, we could run this back on a daily. I don't really want to do that, to see if that's the case. But again, 96.10. After all, you're short from up here. You're short from 690. Or 705, whatever you're short, 710 if you're aggressive. Another thing, so put it at 96 now. The question is, do we think that it's going to go lower? And I would say the chances of that are at best even, depending on what you see, as far as, yes, the trend is still up, but we haven't been below 96 in several weeks. Is there a good reason for that? Well, perhaps, but it's going to depend very much on what you get out of China. Or, say, out of the next Australian PPI number, which I think is out next. My choice on this one would be to put it probably around 610 or 615, thinking that you're going to get, not only are you going to get, I'll deal with that in a second. I'm just about done with this presentation. I'm going to answer some questions. My logic is that the overall trend is going to get, when you get to 96, because of this formation back here and the break here, you're not only going to get people taking profit, but you're also going to get people going long again. So you're going to have a good stall there, and you're not going to, and that's what you're seeing here. All of this buying right here is people either getting long back into the trend or probably buying from here. Okay, now, let me go through some questions here. Okay. I'm going to answer the last one first. I'm going to go through all of them. Would you really want to get short just above 97, the figure? Again, it isn't 97, the figure, that is dictating the short that I'm talking about here. What I am talking about is the formation. that you have a long run up, you have a well-defined channel, you have several tops, you have a penetration and a failure, and then another penetration based on an event, on a news item, and then you have it back into the market. So yes, I would have been short. As I said, my analysis yesterday was to short the channel. That was before we saw what happened today. Okay? You'll have to take my word on that. So again, it isn't specifically 97 the figure. It is the formation, the channel formation, which from my mind was enhanced by the action we saw today. Okay. Okay, that's okay. Let me answer some more questions here. Okay. A bullish trap, I'm not sure exactly if it's a bullish trap or not. I tend to shy away from descriptions like that. You could say that this penetration up here was a bullish trap because it was a pretty reasonable break of the upward trend. However, every time you get a steeper and a steeper trend, and if you had now drawn, let's draw that here. Let's take a look at that, okay? Say that you're betting on an increasing trend. You're going long above, which of course is one of the scenarios. You could make, so you get a little tricky here. Where do you make this one? Do you make this particular here? If you make this line based right here, you could do that. Let's do it. It's not I don't think it's a particularly relevant one, but you end up here. Again, you end up with a shorter one. You could even be more excessive. And the shorter your channel drawings get, the less relevant they are, the less appropriate they are. Okay, channels are a relatively long-term formation. So if you do that, if you're looking to go long up here saying that that's a bullish move here, you have to be wary of two things. One, this particular move was based on a statistic. And this is a reaction. It's not a trend. And two, that as you get increasing slopes in the channel, it becomes more and more unstable. Just like mountain climbing, the steeper, or rock climbing, the steeper the slope, the steeper the scree on the slope, the more likely it is to come down. Same is true here. Okay, so when you say bullish trap, I don't usually use terms like that, but I do agree that that's what it was, and it would have been easy to be caught in that. However, if you remember the fundamental logic, then you're less likely to be caught in that. Okay? Because the logic is strong, but in order for the Aussie to ascend at an even steeper rate, you would need much stronger growth out of China, since that's the basic determinant for the Aussie these days. Or say another thing. Tomorrow or yesterday, the Fed comes out, you know what? 85 billion a month is not enough. We're going to vote 300 billion. Well, that's a good reason. Drive it up. Yes, that would be a reason to do that. But simple, stronger than expected, a little higher than expected Chinese Aussie CPI is not enough. It doesn't change the basic scenario. So if you remembered why the Aussie is going up, then you're more likely to be wary of this being a new and even steeper trend. Because the fundamental reasons behind the trend do not tell you that. So, as far as bullish trap goes, yes, if you like that, that's a pretty good description actually, although I don't tend not to use those. Again, anybody who places orders without stops is not doing their homework. And this is a perfect example, again, of why you need to do that. Perfect example. Okay? And you still could have made money. Because the logic of the situation didn't change. There are times where the logic changes. But this one did not. The fundamental scenario stayed the same, and the technical scenario not only stayed the same, but in fact was enhanced. Okay, let me ask another question here. A risk on or risk off with an instant like the Japanese yen and other pair. What it means is, an even better example would be something like, say, the Brazilian real or the Indian rupee. It means there are two factors in that. One is driving out and one is accepting. Let me explain what I mean. The financial repression, fancy term, in the developed countries, meaning you can't earn any return on your bank accounts, drives money to look for return. And that's primarily what we're looking at. Okay, so when they say risk on or risk off, they are taking a view, say, on a statistic, and it makes the future scenario seem better or worse. Take it another way. If you go back, and I'm not going to do it right here, but if you go back to 2008, remember the problems in the world economy started with the U.S. They started the U.S. subprime market. But when things got ugly, everybody bought the dollar. Risk off. Everybody bought the dollar. We are still largely with that scenario, though it's quite muted. People would say that the same thing was true of the Japanese, of the yen. You know, I don't buy that, but it doesn't matter whether I buy the logic or not. The reaction tends to be the same. Let me do that in a second. So, risk on, risk off. If tomorrow there is a political rebellion in China, what would you see? You'd see the dollar soar. You'd probably see the yen soar as well. Risk off. China is the only, not the only, but the biggest economy in the world with a very strong growth rate. If China falters, if there's a coup in Beijing, I don't think there's going to be. I think the Chinese run a pretty efficient government. But if there was, that would be risk off. The risks to the world economy for recession would skyrocket on something like that. And so you would get risk off into what's deemed to be the safest currencies and economies. The primary choice for that has always been the U.S., the U.S. dollar. The U.S. dollar is the world's reserve currency, and despite what's been going on in D.C. recently, that remains true. There is simply no other market that's as deep as the U.S. Treasury market. Now, part of that, of course, at least recently, is because we've been running up enormous deficits. Nevertheless, that is the basic scenario for risk on and risk off. So, whenever things don't happen to make people nervous over long periods of time, then you get people running their investments into what are easily riskier currencies. The Brazilian real, the Indian, emerging markets, things like that. Okay? Let's see what else we have here. Okay, that's a comment. Let's take a look at that. If you say buy 530, what that system, the last comment there, what that system is saying is absolutely exactly what this channel is telling you. Buy above the base of the channel. The logic down there is even stronger than it is up here. And what would you say? Well, if the base of the channel is 95.30, it's very unlikely that you're going to get, and this is a strong pattern, this is a very strong pattern here. So it's very unlikely that you're going to be able to buy at 95.30, which is probably right about, well, actually, no, I disagree with that. 95.30 is about here. No, I come back to what I said originally. 95.30 is right about here. It's right about the bottom of the channel. You're probably not going to get to buy there. Again, remember, everybody's looking at this channel. Everybody's going to go long at the bottom of the channel. I would. You're not going to get to buy at 95.30. You're probably going to have to buy at 95.50 or 95.55, and you may have a little risk on the downside. Categorize your risk based on the bottom of the channel. I don't want to get in anyone listening to me say, well, I'm predicting a coup in China. I don't mean that at all. I'm just looking for the kind of event that would be a dramatic and also a huge risk-off signal to all the markets. That is true. However, it's very unlikely that the Chinese would do that. The problem for the Chinese and for the Japanese is even if they decide, and they have scaled down their purchases tremendously in U.S. bonds, they don't have to anymore. You know who's buying all the bonds? The Fed. That's a topic for another time. But they're very unlikely to start selling or selling bonds simply because that would destroy their own holdings in bonds, and so that's very unlikely for them to do. And you know, the reason the Chinese and the Japanese buy bonds is not primarily for safe haven status for their reserves. It's to keep it hasn't worked very well for the Japanese. The Fed pays by printing money, by creating deposits on the books of the people who buy the bonds. Actually, excuse me, I made that. What the Fed does is the Fed buys bonds and pays the government, and the bonds just enter onto their portfolio. That's why the Fed balance sheet keeps going up. It gives the money to the federal government when it buys new bonds, and the federal government goes out and spends it. When it buys existing bonds, it gives the money to the people who own the bonds, primarily banks and other large institutions. And what they generally have been doing with the money is leaving it on deposit in the Fed, because banks can't lend it out because nobody's really asking to borrow it. So that's really the way that scenario works. It is very much like playing one credit card with another, except you own both credit cards and you owe the money to yourself. It is not a realistic or long-term play. But again, because this is another topic, I don't want to get into it too much. Okay, let me see if there are any other questions. I know that we're over here. Let me see what my handlers at FX Solutions have to say. Let me just see. I want to make sure if I answered any questions. I hope I got to all of the questions here. I have never heard anything described as turtle soup in the market, so I bend to your knowledge on that. Okay, somebody asked me, what shall we do at the very moment in Aussie? The big break has been here. Okay, you're going to get a lot of back and forth in here. The next move, but it's one which is going to be telegraphed by everyone. This was a great move here because there was this false break. And so that made everybody nervous. You probably had less participants in here because of that. Some people might have shied away. The next logical thing in the Aussie is, of course, to buy above the base of the channel. But that is going to be a move that everybody is going to be looking for. So you're probably not going to, as I said, going to get it at the base of the channel. You're going to get it somewhere, in my mind, between 96. A logical place is probably right here, okay? When you get a move like this, whoops, sorry, where'd that come from? Let's ignore that. When you get a move like this, let me erase that, sorry. Okay, delete annotation, okay. When you get a move like this, one of the things that it means is that there's not a great deal of participation in that area. So the resistance and support lines through a move like this tend to be relatively weak. So where I would probably look to get long on this one is at the base, as the Aussie comes back down, is at the base of this hourly bar right here, which is about 95.50. So I would say for somewhere between 95.70 and 95.50, I would look to get long, because by the time that happens over here, you're all the way over here. And the channel is rising. Okay. I have run over quite a bit here, as is my usual case. Let me just see if there are any questions here that I haven't answered. The other thing I forgot, what I would look for, you can look, and this is a very straightforward and a very clear setup. When I look across technical indicators for confirmation of a particular move, I also look across time frames. So anything that I start on the hourlies, I would then maybe look to an 8-hour. You're going to get the same chart. And I would also look to the dailies to see if there were any daily indicators that this channel is active, and of course there is. I'm not going to go through it, but there is. I rarely used to go below hourlies to look for indications of what to do, or even to look for confirmation, simply because when you get down there's really too much noise in the information. Okay, I think we are finished here. We are. I have answered all the questions that I know of. Let me see if there are any recent ones here. Okay. Yes, that's true for inflation and also for more QE coming out of the U.S. I mean, I really do think that there is and I wrote this up recently, a distinct possibility that the U.S. could actually increase its quantitative easing. It has had very little effect on the economy, but the Fed is in an absolute box and doesn't really have a whole lot of options as far as what to do. Okay, we will end here. It's almost 12:15. I thank you very much for all of your participation. I will put my email up there. I especially appreciate the questions and all of you coming to listen to me. We will be doing this. I also, of course, thank FX Street and all of the participants there. And we will do this again next month. I'm going to perhaps change the presentation a little bit, but we will do again next month one trade preparation webinar and one fundamental webinar. Again, thank you very much. And everyone have a very good day. Take care.